Good day, fellow investors. As discussed yesterday, there were a lot of comments about how to buy bonds, whether to buy bonds now, if you have extra cash, you don't feel like investing. What of a solution today are bonds? I hope to give you the answers in this video. So there were many comments, as I said, how the duration of bonds, how long are you willing to wait? And those are all things that we have to think about. Buying US short bonds instead of keeping a lot of cash sound interesting for a video. So let's show you what I think of it. What is US short market bonds, treasuries, US government treasuries? How would you invest in treasuries? Is it possible with interactive brokers? If you want to support the channel, smash the link in the description below and check interactive brokers. I think they also have a good yield on just cash sitting there. US bond market, can you make a video? So thanks for all those great comments. And if there are a lot of comments about one topic, well, there is no other to do a video. Hope you enjoy it. Smash that like button if you do. Let's immediately start on how to buy bonds. The answer is very complex and you need to use Google artificial intelligence /search and just ask how to buy bonds, and perhaps if you have a broker, whatever your broker is, just ship them an email and ask them, how can I buy bonds? That is the best strategy. With interactive brokers, you need to upgrade trading permissions if you don't have them, include fixed income, and then simply purchase the fixed income you like the most. Other options are short-term treasury ETFs, Vanguard, iShares, everyone has them. So you just need to see what fits you at what moment in time, and therefore I'm going to discuss the risk and reward of investing in bonds, duration, yields, other key factors that you need to know, or I think I can add value when it comes to investing in bonds. And the key factors are, of course, duration, yield, price of liquidity is something that people often forget, real and nominal returns, and of course also currency. So when it comes to duration, if you go to this company, Berkshire Hathaway, if you ever heard of it, if you look at its balance sheet, it has short-term investments in US Treasury bills, cash and cash equivalents. If you look at this star, it is mostly again in short-term T-bills, 104 billion in US Treasury bills, and the average duration is always around 4 months. So that is this company, Berkshire Hathaway. I don't know who runs it, but they have 103 billion in treasury bills. Why do they have 103 billion, 4 billion with 4 months average? Well, let's check the yield on those bonds. And also Warren said that a few years ago, on his investments, he was getting, on his 100 million, he was getting zero. This was last year actually, a year and a half ago. He was getting nothing. And now, on his investments, he's getting more than 5.5 billion, that's with a B, per year extra, just because interest rates on short-term bonds went from 0 to 5.5%. And here we have to discuss duration, short-term 3 months, 1 year, and we have US treasuries where you give your money to the US government up to 30 years. And you can see something very peculiar, that short-term up to a year, but also just a few months, it is 5.5%. And the longer is the time period you give money to the US government, the lower is the yield. This is called an inverted yield curve because of higher yields in the shorter period. Why does that happen? Well, the market expects that the Fed will lower interest rates over time, over the next year and two, and therefore the market is happy to get a lower yield now but lock a higher yield in the future. For example, let's say the market thinks that, I don't know, maybe in a year the yield curve will look something like this. So the market is extremely happy to sacrifice a year of 5 or few months of 2 percentage points difference and pay for 4% to lock in this 4% yield for 10 years so that they are sure that they will get 4%. If you just buy now 1-year bonds at 5%, next year when you want to reinvest it, if the Fed lowers rate, it might be 2%. So you get only 1 year of 5%, but then according to market projections, you get only 2% for the next 10 years, and therefore, of course, it's better to lock in 4.1% or 4% for 30 years. To me, this is crazy, but that is the bet they are making. Also, traders are betting that 20-year yields will go down, which means that the value of that bond will go up. Just a quick mathematical example of what I'm talking. If I pay $100 now for a 4% yield, if that yield goes to 2%, then at the same yield, you are still locking in the 4%, which means that your bond would be worth not exactly 200, but just to get the picture, at a lower yield, the price of the bond goes up. So that would be time, duration, yields, and that is now going on the market. To illustrate a little bit better, this is the 20 years treasury. So we have it here. It was 2% and now it is 4%. So more than doubled the yield has. And you can see here what happened to the ProShares 20-year treasury long-term ETF. What happened? The price of that ETF, as the yield went from 1.9 to 4.1, as had happened to the yield, the price of the ETF went down 50% or whatever, from 54 to 23, a little bit less than 50%. So that is what happens with yields. If yields go up, long-term bonds lose value. And now what's the problem here? If you hold the bond for 20 years, you will get the promised money, no worries. But if you bought here and you need liquidity here and you have a long-term bond, you lost 50% of your capital. And that looks ugly, feels ugly, is actually ugly. So when you want to invest in bonds, you have to ask yourself, okay, for how long am I going to do that? If I would have $1 million now sitting on my bank account, where would I look here? If I would have $1 million and I don't know what to do with it, I would go with this, like Warren Buffett. And then, of course, if it's lower, okay, but why not this and then lock it forever? Because in 10 years, who knows what will happen in 10 years? Who knows when I will find a great idea to put that 1 million into work? If interest rates go up, for who knows why, then I might sell here at 30% down, then this isn't worth it, the 4% isn't worth it. So, as Buffett does, everything into 3 to 6 months treasuries so that you have liquidity, which is the key when it comes to Warren Buffett investing, to all real investing in bonds. Of course, at 5%, you want to park that money. If you have $1 million and you park it for a year at these 3-4 months bonds, ETFs, whatever, you'll have $1,055,000. 55,000 is 4,000 or 5,000 per month. That's not bad just from doing nothing. So if you have $1 million sitting doing nothing, put it in a 3-month treasury and you'll have $1,050,000 by the end of the year. When you start playing longer duration, the risks are getting bigger. Not only, as we discussed, can the price go down if interest rates go up, but also there is something called inflation. If you invest in a 10-year bond now and inflation stays at where it is now, 5% for the next 10 years, you will actually lose 1.52% of your purchasing power for the next 10 years, which is about 20%, 10 years or more, I don't know. But that is the big risk on inflation, which is insane when it comes to bonds. And if you look at the long-term returns on bonds and everything, if you started with $1 200 years ago, stocks would have 700,000. Bonds, real returns, because of inflation, just 1,077. So that is the big deal with bonds, just barely above inflation over the long term, nothing spectacular, big times with no real returns. Then, of course, as interest rates went down from 1980s, great returns of bonds, but if interest rates stay high or go up, or inflation, you actually lose a lot of money. In the 1970s, bonds were called certificates of confiscation. So I have no idea where the yield will go in the future, whether it will be lower as the market projects, whether it will be higher, depending on inflation, depending on so many unknowns. Here, very few were projecting this, because if not, this would be already different. But that is the name of the game. You have to know what and why you are doing. Also, speaking of currency, what is this? $1, euro. If you have a currency, change in currency can also impact you and your returns. If the dollar weakens 10% of the euro and you put euros into dollars to buy treasuries, you can also lose money. That is, again, what you find there. The rates in Europe are still low, so no point in going into crazy bonds. High yield bonds, you need to know what you're doing there, what's the risk there, what's the reward, how long, etc., etc., etc. So, if you have US dollars, you're an American, there is not much to think about if you have nothing to do with your money, or if you need your money in a year, 2 years, take the 5% and enjoy your life. If not, if you have investment opportunities that you think you will do better with less risk, considering inflation a huge long-term risk, then it's also interesting to invest elsewhere rather than bonds, because you are still losing money, real purchasing power, if you invest in bonds. So I'm personally a stock market investor. I have in my portfolio, and you can check that on my research platform, dividend yields higher than 5%, likely 10% in the future. So I'm not interested in bonds that lose power because of inflation, because I invest in businesses that gain on inflation. Thanks for watching. See you in the next video.